we are going to look at the aggregate demand curve, which we will write as AD, and the short-term aggregate supply. And our axes are going to be price level, which I'm going to just write as price, and real GDP. Okay, cool. Alrighties. So we are looking at why the AD curve is downward sloping. Now, I don't want you guys to confuse the aggregate demand curve with a consumer's individual demand curve. When a consumer has an individual demand curve, there are opportunities to substitute. Whereas when there is an aggregate demand curve, a decrease in price, which goes that way, will cause, and a decrease in price level will cause an increase in the aggregate demand curve, which means that the aggregate demand curve is downward sloping. So a decrease in price level means that prices are going down everywhere. There is no opportunity to substitute. So we can't use this like substitution effect that we used for the individual demand curve. For the aggregate demand curve, we need to look at the effects that prices has on real GDP, which we will write as consumption C plus investment I plus government spending, which is G, plus net exports, which is NX. Okay, cool. So a decrease in price level is going to reduce the real value of household wealth, which will cause a decrease in consumption. If price levels decrease, that means that people, the real value of what you hold is now smaller. So you have less wealth, so you can now consume less. The interest rates are also going to increase when price levels increase, because an increase in price level means people now can buy less and they need to borrow more to be able to buy the same amount that they used to. So to be able to buy it, they need to borrow, and when there's an increase in borrowing demand, there's an increase in interest rates, which will decrease investment and consumption to a little effect. So we're just gonna we already have a decrease there. So it's a decrease in consumption and a decrease in investment spending. Okay. And then if the price levels increase, that means the US goods are more expensive. So US goods are more expensive, which means that foreign companies, foreign consumers will be buying more, and the US will be, the US exports are more expensive. So net exports, which is exports minus imports. So if the US will be exporting less because the US goods are so expensive because the price level increased, but the US will be importing a lot more because other foreign goods are going to be relatively less expensive. So if imports increase and exports decrease, overall net exports will also decrease. And remember, we are assuming that government spending is not influenced by a change in price level, so this is going to be zero change. So overall, we have 3 different factors which will cause the aggregate demand to decrease. So an increase in price level will lead to a decrease in the aggregate demand, with these 3 factors being the reason why. So again, to summarize, you cannot use the substitution effect that we were able to use for an individual's price, for an individual's demand curve, but you have to look at these three components when you look at the aggregate demand curve, if that makes sense. Okay, that is the end of the question, and we are good.